Most people in Europe don't think twice when they tap their card or phone. You buy your groceries, you pay for a train ticket, you order something online. It feels instant, simple, normal. But behind that quick tap is a system Europe doesn't fully control. Right now, the majority of card payments in the Eurozone run through American companies, mainly Visa and Mastercard. In fact, close to 2/3 of all card transactions are processed by US firms. That's not a minor detail, that's dominance. And European officials have started to ask a very uncomfortable question. What happens if that dependence becomes a problem? Because this isn't just about convenience anymore, it's about control, it's about resilience. It's about what happens in a world that feels more unstable than it did 10 years ago. Trade tensions are rising, sanctions are being used more aggressively, financial systems are being weaponized. And suddenly, relying heavily on foreign payment networks doesn't look quite as neutral as it once did. That's why the European Union is now seriously exploring something big, the digital euro. Not crypto, not Bitcoin, not some private tech experiment. A central bank digital currency issued by the European Central Bank, designed to exist alongside cash and potentially rolled out by 2029. This isn't dramatic, it's not loud, but it could quietly change how money moves across an entire continent. And the real story here isn't just about technology, it's about sovereignty. Reuters reported, "Today, our payments landscape is highly dominated by non-European providers. This makes us dependent on foreign-owned companies in an increasingly polarised and fragmented world. Almost 2/3 of all card transactions in the EU are now handled by US giants Visa and Mastercard." Dombrovskis said dominance made the EU vulnerable. When Valdis Dombrovskis talked about this, he's not attacking America. That's not what this is. What he's really saying is something much more practical. If you don't control the system that moves your money, you don't fully control your economy. Payments aren't just background technology. They're the pipes that keep everything flowing. And if most of those pipes are owned by companies outside your region, that creates a vulnerability. Maybe nothing happens. Maybe everything runs smoothly, but in a crisis, in a sanctions dispute, in a political standoff, suddenly that dependence doesn't feel so comfortable. And this is where the Trump factor enters the conversation in a very real way. Over the past few years, European officials have watched Washington use economic leverage more openly and more aggressively than ever before. Under President Donald Trump's administration, tariffs were reintroduced as a strategic tool. Trade pressure was applied not just against rivals, but sometimes against allies. Even discussions around Greenland, NATO spending, and European defence commitments added a layer of uncertainty to the transatlantic relationship. From a European policymaker's perspective, that uncertainty matters, because if relations between Brussels and Washington were to deteriorate sharply, even temporarily, Europe would find itself heavily reliant on American-controlled payment rails at exactly the moment when political tensions were highest. No one's suggesting the United States would casually cut Europe off from Visa or Mastercard, but the mere fact that the infrastructure sits outside European control changes how strategic planners think. The Russia sanctions episode reinforced that lesson. When Russian banks were removed from SWIFT and global payment systems, it demonstrated how quickly financial systems can become a geopolitical weapon. Europe supported those sanctions, but it also saw how powerful payment networks can be when governments decide to act. And that realization forced a difficult question. What if one day the pressure flows in the opposite direction? Trump's more transactional approach to alliances has accelerated that debate. European leaders are increasingly aware that American political cycles can shift policy direction rapidly. One administration may prioritise deep cooperation, another may lean into economic leverage to secure concessions. For a bloc of 27 countries trying to think long term, that unpredictability creates strategic discomfort. So this isn't about hostility, it isn't about anti-American sentiment, it's about insurance. It's about making sure that no matter who occupies the White House, Europe retains the ability to operate its own economic system without external choke points. In a stable world, interdependence works beautifully. In a polarised world, it starts to look like exposure. And that's the mindset shaping Europe's push toward payment sovereignty and the digital euro. To be clear, no one in Brussels is kicking Visa or Mastercard out. It's not happening. You'll still tap your card tomorrow. This isn't about shutting American companies down. What's happening is quieter than that. European leaders are basically saying we need our own option. Not instead of, but alongside, and more the digital euro is being talked about as part of that backup plan. The Financial Times reported, Europe urgently needs to reduce its reliance on US groups such as Visa and Mastercard, the head of a banking alliance has said, as officials warn that their market dominance could be weaponized if transatlantic relations were to deteriorate. We are highly dependent on international payment solutions, said Martina Weimert, Chief Executive of European Payments Initiative, EPI. Yes, we have nice national assets like domestic payment card schemes, but we don't have anything cross-border. That word, weaponized, matters. It tells you how this issue is being framed inside European institutions. Officials are not just talking about competition, they're talking about resilience. They're talking about what happens if political relations between Washington and Brussels deteriorate sharply. In a highly interconnected digital economy, payment networks can become leverage. This concern's intensified in recent years. Sanctions regimes, trade disputes, energy shocks, and broader geopolitical tensions have forced Europe to rethink assumptions about globalization. For decades, deep economic integration was seen as a stabilising force. Now, many policymakers believe it also creates vulnerabilities. The Financial Times reported, deep integration created dependencies that could be abused when not all partners were allies, warned Mario Draghi, former ECB president, in a recent speech. Interdependence, once seen as a source of mutual restraint, became a source of leverage and control. That shift in thinking is bigger than it sounds. For years, interdependence was seen as a strength. Countries relying on each other was supposed to make everyone more stable, more connected, less likely to clash. But now that idea is being questioned. And payments sit right in the middle of that debate, because every single modern economy runs on them every single day. The problem is Europe doesn't really have its own continent-wide alternative to Visa and Mastercard just yet. Yes, there are domestic systems. France has one, Germany has one, other countries too, but they mostly work within their own borders. They don't operate seamlessly across all 27 EU member states. And as more payments move online and across borders, many of those national systems are losing ground rather than gaining it. So Europe is trying to build something new. That's where the European Payments Initiative comes in. It's backed by major European banks and it's already launched a digital wallet called Wero. The idea is simple: create a European option for digital payments, something homegrown. But building that across 27 countries isn't easy. You're dealing with different banking systems, different regulations, different consumer habits, different languages. Getting banks, merchants, regulators and customers all moving in the same direction is complicated. This isn't a single country flipping a switch, it's an entire bloc trying to align. And while that's happening on the private side, the European Central Bank is working on something even bigger, the digital euro. This wouldn't be another payment app run by banks, it would be a digital form of money issued directly by the ECB itself, legal tender, backed by the central bank, designed to work online in shops and even offline if needed. That's a much more ambitious move, because at that point you're not just building an alternative payment system, you're reshaping what money itself looks like in Europe. Reuters reported, ceding such a degree of technological control over the EU's economy to others could impede our ability to act autonomously. It poses real threats to our resilience and economic security. A digital euro to be used for online purchases as well as payments in shops would solve that, and work on it should be accelerated. Notice what is being argued here. The digital euro is not just about modernisation. It's being positioned as a sovereignty tool, a mechanism to ensure that even if private networks dominate today, Europe will have a public alternative tomorrow. The timeline is also becoming clearer. If legislative negotiations conclude successfully, the ECB has indicated that the digital euro could become operational by 2029. That's not tomorrow, but it is within the next political cycle. Reuters reported the EU's 27 governments agreed in December that they want a digital euro that would be usable anytime, anywhere, whether users are connected to the internet or offline. Once they finish negotiating with the European Parliament, the ECB can issue the digital euro, which it said could be operational by 2029. Europe needs a digital euro for the digital age. The digital euro should be seen in the broader context of improving Europe's strategic autonomy, Dombrovskis said. This is where the political battle intensifies. Not everyone supports the digital euro. Some banks worry it could compete with private deposits. Some politicians are concerned about privacy and central bank power. The project faces votes in the European Parliament and negotiations are ongoing. The Financial Times reported merchants in the Eurozone would need to accept digital euros in store and online by 2029, when the ECB plans to start issuing the token. The underlying infrastructure would also be open to private sector initiatives to build on. The project is proving divisive among European politicians, and some lenders have lobbied against it, claiming it would undermine private sector efforts. The mandatory acceptance clause is significant. If merchants must accept digital euros, the currency would have immediate scale. It wouldn't rely solely on voluntary adoption. That changes the dynamics dramatically. It means that once implemented, the digital euro would become embedded in everyday commerce. But even supporters admit timing is tight. If geopolitical tensions escalate quickly, some fear Europe may not move fast enough. The Financial Times reported, the problem with the digital euro is it will come in a couple of years, maybe after the mandate of US President Donald Trump. So I think we're a little bit out of time, she added. All of this tells you something important. The debate isn't theoretical anymore. It's not some abstract policy conversation happening in a quiet Brussels office. It's being shaped by real-world events. Trade tensions, sanctions, political pressure, the growing reality that economic systems can be used as leverage. And that changes how leaders think. So what does this actually mean in practical terms? It doesn't mean Visa and Mastercard are being banned. It doesn't mean American payment networks vanish in 2029. You'll still be able to tap your card. Businesses won't suddenly wake up to a different system overnight. But what it does mean is this. Europe is building a parallel track. Not to replace everything immediately, but to make sure no external system dominates completely. To make sure there's always a European-controlled backbone underneath it all. And this isn't happening in isolation. At the same time, Europe is talking about defence autonomy, it's investing heavily in semiconductor production, it's debating tech sovereignty. There's a broader shift taking place, a move towards strategic self-reliance in key areas. Payments are just the latest piece of that puzzle. Because think about it, every salary payment, every supermarket shop, every Netflix subscription, every online order, all of it moves across digital rails. If those rails are controlled outside your jurisdiction, then your sovereignty isn't absolute, it's conditional. The digital euro wouldn't wipe out private payment companies, that's not the plan. What it would do is create a public layer underneath everything, a foundation issued and controlled by the European Central Bank. Private firms could still build apps, they could still innovate, they could still compete, but the core settlement layer, the base system, would be European. Supporters call that resilience. Critics worry about central bank power. They raise questions about privacy, about state influence, about how much control a central bank should have in the digital age. And beyond Europe, global markets are watching something else entirely: fragmentation. The world is slowly organising itself into regional systems. American systems, European systems, Chinese systems. The era of fully integrated global infrastructure is being questioned. If the current timeline holds, by 2029, businesses across the Eurozone may be required to accept digital euros. Consumers could hold central bank digital money in official wallets. Private payment networks could still exist, but alongside a sovereign alternative. That's not a revolution, it's a restructuring. Slow, technical, easy to ignore, but significant. Europe isn't cutting ties with Visa and Mastercard tomorrow, but it is clearly reducing reliance. It's creating options. It's preparing for a future where geopolitical tensions don't stay in speeches, they spill out into infrastructure. And in that kind of world, having your own payment rails isn't a luxury, it's insurance. The debate will get louder as legislation moves forward. Banks will push back, tech companies will lobby, citizens will question privacy safeguards, politicians will argue about competitiveness and cost. But one thing has already changed. Europe is no longer comfortable with the old arrangement. If the digital euro launches by the end of the decade, it will be one of the biggest shifts in European monetary infrastructure in decades. Not because it replaces cash, not because it kills private cards, but because it signals something deeper. Strategic autonomy now includes the invisible systems behind everyday life. This isn't about rejecting globalization altogether, it's about adjusting it. Making sure interdependence doesn't quietly become vulnerability. Will it succeed? That's still uncertain, but the direction is clear. Europe is laying down its own rails, and by the time we reach 2029, the way Europeans pay and who ultimately controls those payments could look very different.